it's going to be a little bit like the pandemic on steroids, where they're going to be faced with a free-falling financial system around the world. And I think you're going to see around the world that response that we got to do big money, which will be the first thing because they can do that quickly. We got to pump money in like crazy.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 25th through December 2nd, 2024, while supplies last. First, we feature backdated 1-ounce silver Austrian Philharmonics at just $3.09 over spot per ounce. We also feature the limited edition 2024 1-ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with over 50 years experience on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah. I haven't seen you in a little while. Good to see you.
Yeah, good to see you as well. Now, you've been calling for a melt-up for the past couple of years now, and it seems like that is what we are seeing in all markets across the board. Just, the stock market hitting all-time highs. It seems like every day. Gold recently hitting an all-time high above $2,800 before this small pullback here. Did you want to kind of give our viewers an update on your macro view and your long-term view of the markets, especially in light of the results from this previous presidential election?
Sure. Yeah, I think the election day actually was kind of lift-off point for what I consider to be the last stage of the melt-up. I've been saying for 2 years that we'd be in this melt-up and that the last stage would go parabolic. And I think we saw that week of the election after Trump won that it did move up pretty aggressively. We're up 5% on the week, I think. So I think that is the beginning of the parabolic. Doesn't mean it's going to go up every day or even every week, but it's going to be a steeper part of the rally. I think we've been in the melt-up for the past year, and looks like it's proceeding as scheduled. I have a target on the S&P now of 7,500. It's probably up from when we last talked, and 25,000 target for the NASDAQ. And Dow, my target is 55,000. The Russell, which has been the laggard, is now catching up. It looks like it's taking the lead, which is what I had predicted, that we would see a broadening of the market into the small caps. We're now approaching, if we haven't already touched the new highs on the Russell, going back to late 2021. So it's been the one market that had lagged, and now it's starting to kick into gear. I have a target on the Russell and have had all year of 3,300. I think, if anything, that's going to prove low. So, if you calculate those targets, basically I'm calling for 25 to 40% upside from here. So we're in the last stage, but that last stage I think is going to be basically parabolic. So things are in pretty much along schedule as far as I can see. I think the bond market, which has corrected pretty aggressively since the September rate hike, is now looking like it's finally finished that correction. Backed up. It had come down from the 10-year had come down from 5% down to 360, and backed up to 450 in the last couple months. And now looks like it's rolling back over, and I expect to see the 10-year down below 3% in the next few months. And ultimately, later on, with a much weaker economy, could go down to zero. That's not a misstatement. I think we could see a 0% 10-year sometime later next year, probably last quarter of next year. And the dollar, which again has been in a counter trend consolidation or correction for quite some time now, that looks like it's finally rolled over. And I think you're going to see that Yeah, I had once it gets down below 100, it got up to 107, I think, maybe a little higher. Once it gets down below par, down below 100, I think you'll see it start speeding up on the downside. So, everything's pretty much in gear as I see it. Weak dollar, lower rates. Fed, in spite of people worrying about inflation, the Fed is still, I think, in the beginnings of an easing cycle that will continue through next year.
No, I know this analysis of a melt up comes from your view that we've been in a bull market for about 40 years now, and that we're coming to the end of that. So does the election, in your view, have any impact on that cycle? And when do you see that final crash following the melt up?
Yeah, you're right. It's basically a 42-year secular bull market. It started in August of 1982. I think we're in the final stages of that. And I think, as I've said, it's pretty much baked in the cake that we're going to have a melt up, and I believe a bust following that melt up, or a big bear market and a global bust. But Trump's policies are dramatically different and dramatically, I think, helpful to the economy longer term, in terms of basically moving us back towards a capitalistic approach to things, less government, definitely trying to take the fat out of the government, less regulation. Definitely going to see, I think, some pretty aggressive deregulating, and all of that gives me some hope that on the other side of the bust, we could see a very strong recovery cycle, and it might head off some things. We might, particularly with AI, we might see productivity improve enough that we can hold back the inflation. My whole scenario is that a global bust, which is the result of decades of overspending and decades of overborrowing, and very much massive leverage on the system, combined with a policy error on the part of the central banks of over tightening, because they're so worried about inflation, that we can get a real crack up in the economy and in the stock market, leading to a response from the central banks of massive money, bigger than anything we've seen. So bigger than the 2008-9, certainly bigger than the $5 trillion that the Fed had to do in 2020, 21. This time, I think you could see as much as $20 trillion out of the Fed in QE and new money, in a response trying to stop a free-falling financial system. It's that money that can jumpstart the next recovery, but also jumpstart an inflation cycle that will go way beyond what we saw this cycle, and even much higher than what we saw in the early 80s. What I'm saying here is that maybe there's a fighting chance that Trump's policies might at least soften that and allow the cycle to extend beyond what I see. But at least right now, I think the macro trumps Trump. The macro is much bigger factor than even his policies. So although I'm very supportive of what he's trying to do, and I think it gives us a fighting chance, we've been doing this so badly for so many decades. Even his aggressive policies may not be enough.
It does seem like, if you look at his last administration, right, he wanted low rates. He spent, more than any president before him. The biggest stimulus package in U.S. history, the COVID package, was on his watch. So it doesn't seem like he's afraid of, going for all the stimulus and bringing rates lower, which would just kind of play into this whole melt-up thesis.
I think the melt-up really, I don't think his policies get enacted soon enough to impact the melt-up. The melt-up's baked in the cake, in my opinion. It's not the result of anything he's doing. And even the bust, I don't think is really going to be, most of it is not going to be the result of anything he's doing. I think the argument that he was a big spender is really kind of, not that it's your argument, I hear it a lot on the street, or certainly in the media. It's a bit unfair in that we had a pandemic and it didn't matter who was in that seat. We had to do that to pull ourselves out. We shut down the world economy, for heaven's sakes. And frankly, it was a good thing that between the president and Congress, we acted fast and pulled ourselves back out of that. So we had a terrible quarter, I think second quarter of 2020, but we went back on the recovery trail pretty quickly thereafter, only because of the very aggressive fiscal and monetary response. So I think it's, again, it's politics that they want to gloss that over and say, well, that was because he's a big spender. He was dealt a set of cards there that nobody could have done any better with. So I kind of walk past his spending and look at basically he has a supply side approach, which is we cut taxes, we're going to raise all boats, we're going to see the growth pick up, and frankly, I think the economics profession, particularly the Ivy League economists and Wall Street economists, have been wrong for a long time in terms of looking at marginal tax cuts and treating it as if that means we're going to get less revenue. The history shows, in both in the Reagan cuts and in the Trump cuts, that we raise revenues by cutting taxes, which makes eminent sense. If you cut prices, retailers do it all the time. Cut prices to get more volume and if you cut taxes, you're going to get more activity, and you're going to, as a result of that, get higher tax revenues. So that too many people equate marginal tax rate cuts with cuts in revenue. That's not how it works. Our problem has been our spending, and I think we're going to see him, go after that. So that's not to say he doesn't do other things where he can. He's not a traditional conservative in terms of spending, but I think generally, if they mean the business, it looks like they mean, we're going to see a lot of the fat come out of the government, and hopefully he can rein in some of the spending. Now, that being said, as I said before, we're going to have massive monetary and fiscal response to a bust if we get a bust, and that's really not in his control. That's really going to be, Congress is going to be doing that. It's going to be a little bit like the pandemic on steroids, where they're going to be faced with a free-falling financial system around the world. And I think you're going to see around the world that response that we got to do big money, which will be the first thing because they can do that quickly. We got to pump money in like crazy, and it'll be matched, I think, in many places by fiscal supports. So you'll see, they'll be bailing out pension funds. They'll be, basically stopping money market funds from going down. They'll be doing a lot of things to try to stimulate and get us back on track. And I view that, again, almost like 2020, in that it's not really part of Trump's policy. It's just going to be a global response.
It does seem like, I guess, looking back at 2020, that he is willing to do things like that, right? Where there's this crisis and then, this record stimulus package. So that's your view then. Once we see the bust, we'll probably see a whole lot of inflationary policies, a whole lot of stimulus.
Yeah, and frankly, it didn't matter who was going to be president. That would be, I think it might, the timing might have been different. You might have had one be slower to respond than another. And frankly, the same thing with the central banks. I think part of the reason we'll have this bust is because the Fed and Jay Powell has already said, I don't want to go back where we were before. So he's going to be very reluctant to print money at the levels that will be necessary to pull us out of that tailspin. And he'll ultimately do it, but he'll probably be a little late in doing it, meaning there's going to be more pain before he gets there. So it's almost we're reluctant to go back to the 2020-21 model. So they're going to be slower to respond than they might otherwise be. But I think ultimately, it doesn't matter who was in that seat as president, it was going to be forced on them.
Yeah, it does seem like people that Trump is bringing in, as you mentioned, are trying to cut the fat out the government. Elon Musk, Vivek Ramaswamy with the Department of Government Efficiency. And then you have the Treasury Secretary, Scott Bessent, who seems to be like a fan of gold and also critical of how kind of the situation that we are in today fiscally. So your perspective on that, it sounds like maybe the situation will force everyone's hand to kind of give in and stimulate again.
Yep. No matter what their best intentions are, I think we are going to see massive stimulus. And initially, it'll be massive effort to keep a financial system from breaking. It'll be basically in a tailspin that they have to first stabilize, then get turned the other way. But with a lag, that will lead to, I think, a recovery cycle that I think this is where his policies kick in, will be an industrial-driven cycle, unlike what we've had for the last 4 decades, which has been, consumer-driven, service-driven. We're going to be seeing a lot of reshoring. We're going to be seeing, basically the need for commodities, et cetera, to, you're building factories, you're building your industry back up. And I think that leads to a commodity cycle because of the demand for commodities. And what we run into is that we've spent many decades kind of moving away from that capital-intensive, commodity-intensive business. And the commodity companies have been rationalized down. Their capacity has been rationalized down to meet the new demands of the last many decades. Now, all of a sudden, because of the macro, the big pumping of money and fiscal increases, and because of the policy moving back towards reshoring, that's all going to force demand for commodities through the roof. And you're going to have limited capacity because capacity has been rationalized down. And then you're going to have this big boost in demand. And so you're going to have demand far outstripping capacity. And of course, in commodities, it takes years to develop new capacity, sometimes a decade. So you're going to have a situation where the only thing that can give is price. And that's why I think you can get very high inflation is, you can have demand outstripping supply and price going up.
No, when it comes to precious metals, did you want to give your forecast here when it comes to this melt up and the bust and then the recovery? How do you see gold and silver reacting?
Yeah, so in the shorter term, meaning in the next 6 months, I'm a huge metals bull. So I think gold's on its way to 3,400. That's my new target. I raised it from 3,000 a short while ago. And silver, I have a target of 75. So it's a long way away, but I think that's what we're going to see in the next several months. I think we've had this pullback here, this correction of late that is running its course, and I think we will see new, both of them move to new highs for this year and then keep going. And that will be driven partially by the dollar. The dollar looks like it's rolling over. I think it's going to roll over hard. I've got an 82 target on DXY. As I said, it's currently just under 107. So, or maybe it may be down towards 106. And so that's a big drop from here. So the dollar will help the metals. Interest rates, I think, are going to fall, as I said before, pretty hard. So that'll help the metals. And then the whole idea that the Fed has begun a long easing cycle will also be a wind at their back. So I think you get this run, and then ultimately the bust interrupts that. So you have a big correction after that big run. Silver might come all the way back down here. Gold might go from 3,400 back to the mid twos or even back to 2,100. So you'll have a good size correction and another re-entry point there. And then the real story is the post-bust period where I see gold going to 20,000 by early next decade, silver to 500, copper will be through the roof. I think copper can get up to $6 pre-bust, meaning the next several months. So it's down in the low fours now. I think you can see price copper up to $6. And, and then after the bust, copper might fall all the way to $1 because it's so cyclical in the bust. And then after the bust, it, easily could go, who knows, $20 might be possible.
Now, looking kind of at the time frame here, it sounds like you're looking for 6 months until, kind of the end of this melt up phase. In the past, I think as we've tracked this with you, you've been very, directionally correct when it comes to the melt up phase, how everything's rising at the same time. It has taken longer than you were initially expecting. So do you see anything that could postpone the crash, or is it really just the final leg that you're seeing right now?
Yeah, as I say to people, the bust is really what ends this, right? Or the market will begin discounting a bust. We haven't had a bust in the post-World War II era, so over 80 years. I mean, you could call the Great Depression a bust, I guess. Certainly was, of that magnitude. But we haven't had anything since then to rival what I'm calling for. So it's not a timing call at all. That, a bust will happen when it happens, but we're moving towards it and getting closer. The melt up itself, I always push it out 3 to 6 months just because it's, you've got, as I said, 25 to 40% upside from here, depending on the index. That's not going to happen in a week or 2 or 3 or 4. So even though I think it's going to be very steep, I assume it'll take a few months. So there's no magic to any timing. I just, as long as the melt up, all the analysis points to the melt up having more runway, I'm going to keep stretching it out. As I say, the markets are in charge of that. It's people are so conditioned to trading calls where they want to know, what day, what week, what month is the market going to peak, and that's just not realistic when you're talking about a big cycle market. It'll peak when it peaks, but I think we're getting very close. Time-wise, we're close. Time, if it's a 42-year secular bull market top and it's 3 or 4 months away, that's close. If it were a 1-year call, 3 or 4 months is widespread. But it's the end of something that's been going on for over 4 decades.
Can you then, I guess, give us a perspective for those who are in a 60-40 portfolio or just, a conventional investment portfolio? People have had a pretty good 43 years, but it sounds like things are about to change. So what would you say to them? I know we can't give financial advice, but it sounds like, times are changing, and what we saw in the past is not necessarily what we're going to see in the future, probably the contrary.
Yeah, exactly. I would say, first of all, and I understand, like I said, from a long-term standpoint, we're close, but close in time, and yet still 25 to 40% upside from here. So my first thing I tell people is you have to understand yourself. And, you might say, because I've heard lots of people say, I don't want to risk, going down the other side of the mountain, so I'm going to get out early. I'm not smart enough to pick the top. And I get that. But just know that if you get out now, the typical investor is going to be compelled to be back in before this thing rolls over. Because if you have a run where you're up 25, 30, or 40% in a matter of a few months, that's going to be psychologically very compelling, because that's how psychology works on investors. Is if it's up, they're bullish. If it's down, they're bearish. And if it's up a lot, they're going to be very bullish. So you can say, I'm big picture, I'm going to get out now. And then if you miss 25, 30, or 40%, this story at the top is going to be compelling, or you wouldn't be there. The story's going to be, I can pretty much predict the story's going to be, the Fed's got a lot of room to ease. Things have slowed down. Inflation's rolling over. The cycle looks like it has several years to run. This is not the time to get out. That will be what will be at the top. So understand, it's not going to be, there's no bell that goes off. There's nothing, you're not going to be sitting there 25% higher saying, oh, I'm glad I got out. You're going to say, I got out and this looks like I could have another 50%. So know yourself. If you have that discipline to say, I'm not worried if I miss a lot, I'm, like you say, it's the end of 40 years. If I miss a year of it, big deal. If I miss 6 months of it, big deal. If you're like that, then maybe you can get out and rest easy. But for most people, that is going to make a difference when it runs. And so if that's the case, understand that, yes, a few months isn't very far away, but 25 or 30% is a lot of money to leave on the table. It's usually, let's say the Russell, which is almost 40% from here. That's basically 2 or 3 years worth of returns, even if it can come in a few months. So that's first, is kind of know yourself and figure that out for yourself, how you'll behave if that's what happens. And then the other big thing is this whole buy and hold attitude we've had for probably 30 years, from the mid 80s. The mantra for most of the financial advisors is you can't time the market. Nobody's smart enough to time the market. So it's time in the market. It's buy and hold. And that's worked great. If you just put your money in an index fund 30 years ago, you're sitting pretty. You made a lot of money. The problem is the environment going forward is going to be the opposite kind of environment. Instead of rates coming down for 30 years, rates were 40 years. Rates were 15% on the 10-year back in the early 80s, and they got down to 0.4% in 2020. We have one more run where I think you can get to zero, so maybe even a new lower low on rates. But once that happens, we begin a big bear market in bonds, and rates will be going from that zero level on the 10-year, where by early next decade, I think they'll be close to 20%. That's damaging to index funds because index funds depend on PE multiples expanding. The reason you did so well the last 3 or 4 decades is because PE multiples were expanding because rates were coming down. When rates are going up, PE multiples will shrink, and you'll go back from 25 times earnings to single digits. And it'll be very hard to overcome that shrinkage in PE multiples, even if you're in an index where earnings are doing okay. So it'll be the complete opposite environment. And then it's a stock picking environment where index isn't the name of the game. It's more what types of stocks will do well in inflation, what types of stocks will do in an industrial recovery. And then it's commodities, it's caterpillars of the world, big heavy industry, et cetera. There'll be other things too, but it'll be a very different leadership and a very different kind of approach to investing. Bonds won't do well, so 60-40. Bonds in an environment where the interest rates are going sky high, bonds will get hit hard. So 60-40 doesn't do you very well. What will do well, you can have 60-40, but that 40 in bonds, instead of being in 5, 10, 15, 20-year bonds, you'll be best to be in treasury bills and rolling them every 6 months at higher rates. That way you're refreshing the rate as the rates go up. So it will take a different mindset. And I can promise you right now that most financial advisors aren't going to be there at the beginning. They're going to be looking at what worked before. It will, over time, that's what people will gravitate to. But if you want to be ahead of the curve and benefit when, things change, you're going to have to think ahead and understand it's a different environment. And then ultimately, it's, in the bust, which is before the next cycle. In that bust between this cycle and next cycle, you could have an 80% bear market. And so, again, it will behoove you to not be a buy and holder, but say, I've done well. I want to take something off the table and prepare for the next opportunity.
And if our viewers are interested in continuing to track this with you, I know they can find you on Twitter and also sign up for your newsletter by messaging you. Can you tell us a bit about that?
Sure. Yeah, I'm on Twitter pretty much every day, mostly through replies. So people have to be aware that I'm not the expert on Twitter or on X, but it seems that if you don't have your settings set right, you can miss all those replies and just be seeing the original posts. And I don't do a lot of original posts. I don't initiate posts. Most of it's replies to other people. So, but I am on there every day, oftentimes dozens of replies a day. So if you're not seeing that, that probably means your settings aren't quite right. My handle on Twitter is at Dave H. Contrarian, not David, but Dave H. Contrarian. Like I said, you can pretty much follow my conversations there every day. In terms of my quarterly letter, I put out a macro letter that I publish every quarter, and that is by subscription. So if anybody is interested in it, it comes with a cost. Just direct message me on Twitter, and I will give you details.
Fantastic. David, thank you so much for your time today. Any last thoughts before we let you go?
Well, we're in for what I think is exciting as this past couple of years has been. Get ready, because I think the next 3, 4, 5 months is going to be probably the most exciting of all. So, don't blink is what I would say. And other than that, just happy Thanksgiving to all those that live here in the U.S. and happy holidays for everybody going out into the holiday season.
Thank you so much, David. Happy Thanksgiving. Merry Christmas. Happy holidays. Thank you so much. God bless. And you have a fantastic day.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 25th through December 2nd, 2024, while supplies last. First, we feature backdated 1-ounce silver Austrian Philharmonics at just $3.09 over spot per ounce. We also feature the limited edition 2024 1-ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.